Investing is one of the most powerful ways to build wealth, yet it's surrounded by myths that prevent many people from getting started, or worse, lead them into financial traps. Whether you're a beginner or someone with years of market exposure, falling for common investing myths can cost you dearly. These myths often come from outdated advice, fear, or misinformation passed around by well-meaning friends, family, or online influencers. Believing them can lead to missed opportunities, emotional decisions, and a poor financial future. In this video, we'll debunk the 10 most dangerous investing myths and explain what you should believe instead to make smarter, more confident investment decisions. 1. Investing is only for the rich. One of the most damaging myths is that you need to be wealthy to start investing. In reality, platforms like Robinhood, Fidelity, and Vanguard now allow you to begin with as little as $1. Fractional shares, micro-investing apps, and employer-sponsored 401ks have made investing accessible to virtually everyone. Waiting until you're rich to invest is backward. Investing early is often how people become wealthy in the first place. Compound interest rewards time, not wealth. 2. The stock market is just like gambling. While both involve risk, investing and gambling are fundamentally different. Gambling is a zero-sum game with short-term outcomes and negative expected returns. Investing, on the other hand, involves owning assets that create value, businesses, real estate, or funds that produce income. Over long periods, the stock market has delivered consistent, positive returns. It's only when people speculate without research or discipline that investing becomes a gamble. 3. You need to time the market to make money. Trying to perfectly time the market, buying at the bottom and selling at the top, is a fool's errand even professionals rarely achieve. Data shows that missing just the 10 best trading days in a decade can severely hurt returns. Instead, consistently investing over time, known as dollar-cost averaging, removes emotion and captures market growth regardless of short-term volatility. Time in the market always beats timing the market. 4. All debt must be paid off before investing. While it's important to manage high-interest debt, delaying all investing until you're debt-free is often a mistake. For example, student loans or mortgages with low interest rates, 3 to 5%, might cost less than the average 7 to 10% annual return from long-term investing. The key is balance. Aggressively pay down toxic debt like credit cards, but still invest in tax-advantaged accounts like 401ks or IRAs to avoid missing out on compound growth. 5. Safe investments have no risk. Many people think cash, CDs, or savings accounts are risk-free, but they ignore the hidden danger: inflation. If your investment returns 1% but inflation is 3%, you're effectively losing purchasing power. While safe investments avoid market volatility, they often fail to protect long-term wealth. A well-diversified portfolio balances risk while offering inflation-beating returns, something ultra-conservative vehicles cannot provide over decades. 6. You should pull out when the market drops. Selling in a downturn is one of the worst decisions an investor can make. Market declines are natural and temporary, and history shows they're always followed by recoveries. Those who panic sell lock in losses, while disciplined investors who stay the course often emerge stronger. Warren Buffett famously said, "Be fearful when others are greedy, and greedy when others are fearful," a mindset critical during volatile periods. 7. Investing is too complicated to understand. Another myth is that investing is only for experts or people with finance degrees. While advanced strategies can get complex, basic investing is surprisingly simple. Low-cost index funds, target-date retirement funds, and robo-advisors make it easy to build a diversified portfolio with minimal effort. Resources like books, The Simple Path to Wealth, The Boglehead's Guide to Investing, and free courses make financial literacy more accessible than ever. 8. You need to constantly monitor your investments. The idea that you must watch the market daily can lead to stress and emotional decisions. Long-term investing is not a day job. It's about letting your money work for you over years or decades. In fact, studies show that investors who check their portfolios less frequently tend to achieve better outcomes because they avoid reacting to short-term fluctuations. Automating contributions and rebalancing annually is often more effective than micromanagement. 9. Past performance guarantees future results. One of the most common disclaimers in investing is also the most ignored. Past performance does not predict future returns. A fund or stock that performed well last year may underperform next year due to changing conditions. Chasing winners often leads to buying high and selling low. Instead, a diversified strategy based on asset allocation and time horizon is far more reliable than trying to pick last year's star performer. 10. Real estate is always a safe bet. While real estate can be a valuable part of a portfolio, it's not foolproof. Property markets fluctuate, maintenance costs are real, and poor location choices can erode value. Moreover, high leverage in real estate, taking on large mortgages, increases your risk. Unlike stocks, real estate is illiquid and can tie up capital for years. Believing it's a guaranteed moneymaker can lead to poor investment decisions, especially during economic downturns. Believing the wrong things about investing can be just as harmful as not investing at all. Myths like, "You need to be rich, it's gambling," or "You should wait for the right time," cause people to miss out on one of the most powerful tools for financial freedom. The truth is, successful investing requires a mix of education, discipline, and patience, not perfection or timing. By replacing myths with facts and action, you empower yourself to build real, lasting wealth. Whether you're just getting started or looking to improve your strategy, breaking free from these myths is your first step toward a better financial future.